Welcome to the daily update, where I'll go over the action in the market for Tuesday, August 20th, and we'll see how things look for Wednesday, August 21st. A real lackluster day, not much conviction by either the buyers or the sellers. On the positive side, the market's holding on to its gains. We had a bit of a down day, but we're working off some of these extreme positive readings on some of our indicators, both in the short and intermediate term. We're still looking positive across the board, though. The big news in Wednesday's session is going to be the FOMC meeting minutes. Then on Thursday, we will get initial and continuing jobless claims. Friday is going to be another big day with Chair Powell giving a speech at Jackson Hole. I do have a thing called the SPXInvesting Program. It's still free. I was going to lock it down in August, but I've decided to delay that a little bit due to travel plans coming up. If you want to learn more about the program, please click on the link in the description below this video. It's free for right now, and there are additional videos that I post on there. And there's a course that you can take, and there's other courses that I'll be rolling out after I actually lock things down there. I am delaying the weekly videos to give members first access. So I usually post them on early Saturday and Sunday. They won't be rolled out until Sunday evening and made publicly available to everybody on YouTube and Rumble. The daily video is the real foundation of the analysis that I do. All the other videos are meant to supplement the daily video. Let's go back and talk about what happened and then look at some charts. We did have a slightly higher open. Prices briefly went positive, and then we dropped below the unchanged level. And then that's how we spent the rest of the day. We chopped below the unchanged level to the upside and the daily pivot at 55.89 to the downside. And we ended up closing right in about the middle there, slightly negative. We were down 0.2% on below average volume. This is more normal for August. You would think that volume would really drop off, but lately, up until when we were really going down, volume was above average. As we've been going up, volume has been below average, and that is a bit of a concern from a technical analysis perspective. And we are positive in the short, intermediate, and long term, but kind of working off these extreme readings right now. And it'll be about what did the Fed say on Wednesday. That's what the market's going to look at the meeting minutes and see if they can get any insight there. There are different geopolitical events that don't seem to be having much of an impact on the market, but that can always change. There was a real lack of conviction by either buyers or sellers on Tuesday. We're now slightly below that 5,600 level. That's what I was watching on Tuesday. I have some long positions that will benefit if the market goes up, but they're seeing profits right now, but I hate to give back profits. And so I was really watching the 5,600 level to see, are we going down below that with any real conviction? No, we didn't. We just went down to the daily pivot, and that ended up providing support. So even though we're underneath 5,600, we're still holding up, at least on an intraday basis, with that support level. On a short-term basis, we still have our 20-period exponential moving average that we put right on the S&P. That's still extreme positive, as is the rate of change going back 10 periods. The Stochc RSI, Williams percent R, the CCI 14, and the 20 should also be on this list. The stochastics, and then the boom indicator. We're still kind of far away from that 20-period moving average. A little bit shorter list, but still we have some things that we're watching in the intermediate term that are extreme positive. The CMB composite, the Swenlin trading oscillator based on volume, even though it came down, it's still a little bit extreme. The Sean trend meter and the Chaikin oscillator also declined a little bit, but still right on that border of looking extreme. In the long term, we have the rate of change going back 200 periods on the shorter version of the chart that I show. And also we're a little extreme with the 200. We did knock off the 150 on this list that had been there. And no real change with the scenario. We'll see if the meeting minutes on Wednesday and then Chairperson Powell's speech on Friday, if that makes any changes, that the Fed's been leaving rates higher for longer, and the market is really anticipating a rate cut in September. The dollar was down and interest rates were down. We closed at 3.82% with the 10-year yield. where after Monday we were at 3.87%. We're still inverted with those yield curves. Sentiment is still ticking up a little bit. We had been at 41, which was negative. Now we're into the neutral area at 42. And our trend is still positive. We have the green line above the red line. I switched the bias over to mixed just because we had a slight down day, but the momentum, the last number of days taken together, continues to be positive. Didn't have any economic reports, so there's no charts to show you here. Here's the overbought, oversold composite. We're getting up close to that 80 level. Now, usually about 80 or above, that's when we start to get extreme. Now, we tend to look at overbought and oversold by looking at various indicators and charts that I show throughout this video. This is more of a composite, trying to take a lot of things together. And this is also a weekly chart, so it's longer term. But we're just showing good momentum for right now, not really getting an extreme reading. We look at the buyback authorization announcements. This is still going up, which tends to be positive for those individual stocks as well as the market as a whole. Consolidated equity positioning is going back up after it had dropped down below zero when we were going down. Now folks are starting to jump back in. And then the earnings per share revisions, they're less negative than usual. So I guess you could say they're more positive. It's kind of a double negative there, kind of in a sort of way. But 2024, this is the dark blue line. This is how we're seeing the earnings, the revisions coming in, but it's less than the median. And that's where they come up with the headline here. But they're still looking pretty positive going out into 2025. And then this chart, I don't go through all of this aspect. I just kind of look at the top and the bottom parts here, where you're seeing a lot of money going into real estate investment trusts. As interest rates are coming down, those tend to be more attractive types of investments. A lot into financials, a lot into tech, where we're seeing a lot of money coming out of Japan. One thing that's interesting, at least from Bank of America's perspective, we're seeing money coming out of healthcare, which is more defensive, and then tips. These are Treasury inflation protected securities. These are what folks get into when they're worried about inflation rising and interest rates going up. Well, we seem to be in that opposite kind of an environment, which is why we're seeing money coming out of them. And then looking here, this is the real Fed funds rate. This is taking inflation into account, where they take the Fed funds rate and then they subtract the inflation from that. And it shows that it's continuing to go up. And this is what I talked about in yesterday's video. Even though inflation's coming down, we still have that compounding effect from previous months that still get figured into the overall equation. And inflation expectations, though, are hitting a low here, actually dropping down below this 2% level for right now. Now, this looks out into the future. This is 3 years into the future, and it's called the break-even point, where it's coming under that 2% level that the Fed has been trying to get to. And then cyclicals, these perform as the economy performs. These are stocks that tend to go up when the economy's doing well and go down when the economy's not doing as well, versus defensive stocks, which tend to do better when the market's under pressure. And we see that in the US, the cyclicals are going back up, and we're also seeing that pretty much globally right now. And then this is kind of the opposite of what we really focus on here. We want growth to outperform value. That's when the indexes really go up. This chart is showing how value has really been underperforming growth. Not quite down to this 0.5% standard deviation yet, but still just showing how value on a longer term basis is underperforming. And then a couple of Twitter charts. I thought this was kind of interesting. This just goes back 100 years, just a mere 100 years here. And if you plot this trend line on here, what do you think is going to happen if we break above that? Are we going to break above that? This is some very, very ultra long-term overhead resistance that we could be bumping into right here. And I don't know, I haven't seen any of the perma bears talking about this, but this could be kind of a significant level that we're dealing with right now. Very, very long term. We haven't broken above it yet. And then I'm also going to post this in the weekly video. This is historical for the most part. And this is put out by Stock Traders Almanac and just showing inflation and then what happens with stocks after that. And then different events that have happened going back about 100 years, 100 plus years here in this chart. Now, looking at our intraday chart, and I keep trying to include as much of the decline in this chart as I can, but a real slow day over here. We did have a slightly higher open, but then quickly went negative, never went positive again after that, but the daily pivot ended up providing support. No real change now. Things are kind of slow on an intraday basis in the initial overnight session here with the SPY intraday chart. And we're still seeing this where the red line is above the blue line. We would like to see the blue line above the red line to show that growth is outperforming value intraday. And this is another thing that I want to go back here to this August 5th, August 6th area. And you can see how growth has been improving for the S&P itself. And we want to see that continue to stay more positive. End of day, growth was down, but down less than value. It was down more for the mid caps and down, but down less for the small caps. And we're not really seeing much of a change here, but it's not necessarily falling apart either. When we look at our growth to value ratios on the end of day here with the small caps, the mid caps showing a little bit of an improvement and a little bit of a tick up, but not really breaking out with S&P growth to value. This is still inside the rainbow when we look at the growth versus value ETF here. We would like to see this continue to go up if we're more positive on the market. Not seeing anything all that great here with discretionary versus staples, but it has been bouncing up lately. And here's large cap growth. This is looking more positive. We were able to get back above the 50-day moving average. And even though we were down slightly, this is still a pretty healthy looking chart. And we look at the ratio between large caps and small caps. We actually went up just a little bit here as the large caps had a little bit better day than the small caps. Our trend it's positive for right now because the green line is above the red line. The concern is that the ADX continues to drop and it's below its moving average. That suggests a weakening trend, but because we're above the static number of 20, we are still in a trending environment. And we're seeing a similar thing here with the short-term ADX, but short and intermediate term, we still continue to be positive. We're still dropping off though when we look at volume. And then sentiment, we're coming down a little bit here with the Ulcer Index after it had been giving us some rather high readings. We ticked up slightly here with the VIX on a closing basis with the line chart, and we closed at the top end of the bar here with the bar chart. And because the VIX was up, we saw a little bit of a tick up here with the VIX of the VIX, both with the bar chart and the line chart. But the momentum of the VIX continues to be down after spiking up. The MACD is still showing that it's headed lower on a momentum basis. And then here's the historical chart where we've seen something similar where we saw a real move up in the VIX and now we're pulling back. Is that going to resume going up, which means that could be pressure for stocks? The equity put call ratio did go up, maybe some hedging ahead of some potential things going on here. But when we look at our 5-day chart and our 10-day chart, we're still continuing to decline, and that's more positive for the market. We still want to keep an eye on the spread between the risky and not as risky bonds here. And we want to see this, even though it's inverted, we want to see this continue to go up if there's less risk. If this really continues to go back down, that shows an increase in the fear of the spread that's displayed between the risky and not as risky options for bonds. And then we declined with this fair gauge where we were up slightly with this other fair gauge. So seeing a little bit of a mixed picture there. We look at the risk on to risk off ratio. We declined just a little bit here. And volatility, excuse me, volatility risk premium is giving us a very, very low reading, but it could be starting to bottom out, possibly. We're looking okay here with the advanced decline line. We declined based on price and volume. We're still seeing this negative divergence where we broke out based on price. We have not broken out based on volume, but still both of these are above their moving averages. And you see the red lines, they continue to go up. So that is positive internally. And we did see with that little bit of positive action earlier in the day, we saw a breakout of the new highs enough to keep our 5-day going up and our 10 days back to going up. This is another internal measure that's holding up, and we're not really seeing any new lows being generated for the S&P. After being extreme, the 19-day advanced decline ratio has now declined a little bit. The 39-day declined as well, but we're still above zero. So this is positive. And this is going with that same chart here where we had been extreme positive based on price and volume. Well, they pulled back slightly in Tuesday's session. We're still showing some improvement here. This moves a little slower. This is the 10-day average of the S&P 500 highs minus the lows. This continues to go up. And here's our accumulation distribution, getting a little bit turned over here with the boom indicators, suggesting that we have become kind of far away from the moving average. But this is not a real true representation of what's going on here. So we notice this and respect it, but at the same time, you can just tell by looking at this that we have been further away from the moving average than we are now. Another positive takeaway is that we're starting to see the red line turn back up, and that is more positive. So taken together, this is positive. Jake and money flow finally starting to roll over. We were already treating this as positive since it was going up. Now we're just seeing a little blip there of green as it officially turns positive. And we ticked down just a little bit. We came up to this red line with the Chaikin oscillator, but this continues to be positive as well. The vortex was flat with the green line, but the green line's still on top, so we're positive. And ticked down a little bit with the cumulative S&P 500 based on price and volume. We're still breaking out based on price. We have not broken out yet based on volume. A bit of a negative divergence there. And even though both declined, the red line is still above the S&P 500, even though they are on different scales. This just shows that the broader market is holding up, at least for right now. And then we look at the NYSE cumulative advanced decline line, where this did decline, and it's below the moving average, where the regular NYSE advanced decline line ticked down, but is still above an advancing moving average. We're also seeing a bit of a tick down here with this other NYSE advanced decline line, but above the moving average. We look at NYSE common stock. This is based on price, where we saw a bit of a decline as well as volume. And we did break out a little bit more here with price. We haven't quite broken out here based on volume. A little bit of a negative divergence there. And even with the decline that we saw on Tuesday, when we look at the broad market, we're still positive when we look at the 5-period moving average of the highs minus the lows. And we came down, but we're still above the moving averages with all the different indexes that we follow here. So we're still looking okay. We're above the 50-day moving average, but on the bottom, we are dropping below average with volume here on the daily charts. The condition of the 20-period moving average trend still shows that there's improvement. The longer we stay above both of these lines, the more improvement we will see. Here's the simple and exponential moving averages. The blue line is above the red since the blue moves faster, and this is still looking positive. We're coming down, but just barely extreme positive with the 20-period exponential moving average of the S&P, declined with the 50, and we were pretty much flat with the 200. With our short-term indicators, we are still extreme positive with the Stochc RSI, the Williams percent R, the CCI 14, and the CCI 20, and the stochastics rolling over, but still extreme in the short term, trying to roll over, but still extreme in the intermediate term, continue to be positive in the long term. And the force index, no longer extreme right now. It kind of came down just enough to get away from that upper Keltner band there. And we're no longer extreme here with our rate of change going back 5 periods. We'd spent a few days up above this blue line. Now we're starting to drop back down. But we're coming down, but still extreme with a 10-day rate of change. And we're coming down here. We're still extreme when we look at the boom indicator. That measures the distance away from the 20-period moving average. But it did tick down slightly. We're still looking fairly good here with the distance from the 50 and 200. And we're not extreme here with the standard deviations chart. We're just a little bit below the border between the +2 and +3 channel. And we tick down, but we're positive with the balance of power. We're rolling over a little bit, but still extreme with the CMB composite. The condition of the 50-period moving average, we're above both lines. Both lines are going up. That is positive. And here's our regular 50-period moving average study, above both lines. So we were able to get back above that, and that's more intermediate term. So here's all the moving averages. We are currently above all of them with price, and we're seeing the shorter term moving averages starting to turn back up. And we're still getting brown signals here with the go, no go system. We're still dealing with the upper band here with the highest high value. That's the blue area. The TTM squeeze continues to be positive, and standard deviation is still showing that we've been moving pretty fast here based on the movement of the S&P 500. We tick down, but we're still positive with the ease of movement. The Erin is off at the beach still. After being extreme with the S&P McClellan oscillator, we now have come back down, no longer extreme there. But we're still positive since we're above zero, so the summation index based on price and volume continued to go up. We came down, but we're still positive here with the NYSE McClellan oscillator. And since we're above zero, we continue to go up with the NYSE summation index based on price and volume. We came down a little bit with the Swenlin trading oscillator based on price. We came down based on volume, but we're still a slightly extreme positive. Momentum, though, has switched back to positive pretty much across the board. We're going up with the PMO, going up based on price and volume. Our studies, we had been extreme here with the PMOs that were rising. That has now fallen back. We're still going up with the buy signals, and we're kind of flat to slightly rising with the PMOs above zero. We're positive with the Elders Impulse system for the S&P. We're positive with the parabolic SAR with the dots underneath. We're positive with the short-term slope oscillator. We're above zero and continuing to go up above the moving average. And the MACD is also turned over positive and is above its moving average. So in the short term, we're positive. Intermediate term, there are 3 oscillators here. We're crossing back above the moving averages here with our long-term oscillators, the TRIX and KST. The Copic curve, another momentum oscillator, is positive and above zero. Sean trend meter starting to get into that initial extreme positive area. And the bullish percent index continues to go up, even on a slight down day. That's rather encouraging. That means the rest of the S&P is holding up fairly well for right now. And we're looking positive here with the NYSE bullish percent index. And we're continuing to go up with the NASDAQ 100 bullish percent index. Now, if we break above 70, that's when we start to get into an extreme positive reading territory. And we tick down a little bit, but we're still above 50 with the money flow. We're coming down after almost getting extreme here with the ultimate oscillator, but this is still positive. We decline, but we're still above an advancing moving average with on-balance volume. The RSIs are still above 50, even though they tick down slightly, suggesting good momentum there. After getting above this 80 level, we did come down a bit with the stocks in the S&P above their 20-day moving averages. And so we're coming down, but we're above the 70 level, which according to this study, that's just showing that there's good, solid momentum. We tick down, but still above 50 with those stocks above their 50-day moving average. Also tick down with the 100, but still positive. Tick down, but still positive with the 200. And we're getting a little closer here with the mass index. If we cross down below the red dashed line, that's suggesting a reversal. And we don't really know what that will be, but we can guess that since we were really going up here, when this finally triggers the third part of its signal, then it would suggest that we might go into a downtrend. Support levels, we're above the Ichimoku cloud, but we're turning positive now because the blue line still continues to be above the red line, and the green line, which is a lot harder to see here, it ticked down a little bit, but it continues to be positive. And we're above all of these lines here with our little mini rainbow that's based on 20-period moving averages. And we're still above the 50% level here when we look at fib extensions for the S&P. And we are starting potentially a new 50-day cycle now. Sometimes that means something, sometimes it means nothing. And the weekly chart here, we're still above this R2 level. So this support level continues to hold up. We're still looking good with the trend. The Heiken Ashi is positive. The Kegi chart is black and pointing up. That's positive. We're positive with the Renko chart, and we're positive with the 3-line break chart. Long term, we're no longer extreme with our 150 moving average. We're coming down, but still above this red line with the 200-period moving average. Going back in a shorter term version of this chart, the rate of change 200 periods, we're coming down slightly, but we're still above this blue line. We're still positive with all the different time frames according to the Keller market model across the different indexes that we follow. No change here either. We're positive with stocks and bonds based on price. We're negative with commodities, and the dollar on all time frames. Still positive with the decision point scorecard. And we had some nice little bullish signals that were triggered right after the open when we were positive, but then we ended up being negative the rest of the day with the signals. And we saw energy down the most and staples were up the most, but not any real conviction either way, other than energy really taking a hit right now. We look at the equal weight versus the S&P. The red line's still above the bar chart here, even though they're on different scales. We like it when it's above. That suggests that the rest of the S&P is hanging in there. And we went up just a little bit as the large caps did slightly outperform the rest of the S&P itself. We're still positive here with the new highs minus the new lows. We're above zero with this reading. And we were down slightly with the Dow, but really no change there. We're still positive with the diamonds when we look at the Elders Impulse system. The NASDAQ still hanging out right at this pivot point now above its 50-day moving average. So that support is holding. We're not back down to the pivot point here with the NASDAQ 100, but also above its 50-day moving average. We're positive with the Elders Impulse system. The momentum for the NASDAQ 100 is still positive. And we look at the FANG index where we're still above the 50-day moving average, even though it declined slightly. And here is the Q chart. We're still above all of the plotted moving averages here. And here's the fib extension chart. We're still above this 23.6% fib extension level. The small caps down over 1%, but still kind of in the range that they've been in for quite a while now. They are still positive, though, with the Elders Impulse system. For the small caps, we're still above 50 when we look at the Russell 2000 small cap index with the RSI. Even though it did decline, we're still above the 50-day moving average, and the momentum is trying to turn back up positive. When we look at the ratio between small caps and tech, this continues to go down as tech had a better day than small caps. And the mid caps continue to be positive here. And here is the chart where we've not been able to get above this pivot point, at least yet, but we are above the 50-day moving average. The Wilshire is still above its 50-day moving average. And the big ETF that we follow, it was down 0.25%, but still above its 50-day moving average. The staples to tech ratio was actually up a little bit, but overall it has been declining lately. To be more positive, we want to see this continue to decline. And then looking at some of the individual stocks, we're still above the 200 period moving average with Amazon. Apple is above its 50-day moving average. Microsoft is right in between, both its 50 and 200. Google also in between. Meta is still above its 50-day. Tesla, it was down 0.75%, but still above its 50-day moving average. NVIDIA was down a little bit over 2%, but still above its 50-day moving average. And the financial sector here, looking pretty good, pretty solid. Even though it was down 0.33%, we're still above the 50-day moving average. And then Netflix. I don't know why some of these charts are out of order. I thought I had rearranged these, but Netflix was up 1.45%. And this is what we're keeping an eye on. It's a divergence. We're not sure if it's positive or negative. I kind of lean more towards the negative side because the S&P has been going up and the home builders have been languishing. That's what's producing this really low reading with the correlation. So we want to keep an eye on this. This could be negative. And I went back and I marked other times we had readings in the recent past. It didn't really mean all that much necessarily, other than we just kept more or less chopping sideways after that. And then oil continues to drop. We're down in the 73 range. The dollar is really falling, but not enough yet to see a death cross yet with the trend. And looking at US versus international stocks, the short term and even the longer term correlation continues to be strong. We were down with the 10-year yield. We were up with the 10-year based on price. Growth to value, looking okay above the moving average when we look at the Qs to S&P. Discretionary to S&P still below a declining moving average. We're a little bit above the moving average when we compare large cap growth with large cap value. And here's another look at the indexes with the large caps doing okay, mid caps still above the moving average, as are the small caps. The S&P to utilities ratio it's ticking back up just barely here, but we want to see this continue to go up to be more positive. And we're ticking back up just a little bit, but we have been declining with our staples to S&P 500 ratio. So what's our outlook for Wednesday? We're kind of keeping just an open mind to what might happen on Friday because Chair Powell will be speaking at Jackson Hole. We're going to get some big earnings reports from retail companies this week. The technicals are still positive, but right now it looks like we're just working off this short and somewhat intermediate term overbought condition. We're going to get the MBNA mortgage applications, and then the big one is going to be the FOMC meeting minutes, and they'll come out at 2 p.m. Eastern time, and then all the different crazy things going on here. And then Thursday will be the jobless claims, Friday will be the speech, and then new home sales as well. And here's another look at this economic chart. Seasonally, we're neutral to positive with the Dow, where we're flat out positive with the S&P and NASDAQ. So we have that going for us. We are still dealing with the week after options expiration, which tends to be more positive than negative. And Wednesday is one of the most negative days of the week based on what happened in 2023. So we're seeing some negative seasonality according to this chart right here, where see the NASDAQ seems to see positive seasonality, but the S&P, that's green, that sees a little bit of weaker seasonality there. This is an updated chart. This is the election year pattern from 1949 to 2023. This is what we've been doing now. And then these are all election years taken together. And then this is when it's an open field election, meaning that the current president's not running for re-election. And we do want to keep a mind open to September being one of the weaker months seasonally, both on the previous chart and on this chart. And then when we take August through October together, we tend to not have very good returns during that time. But August tends to do well during an election year. And then this is how we look so far. And a lot of people are drawing some real comparisons to 2024 compared to 2023. And yeah, there are some. But in July, this is really when we started to see some problems that developed into the market. They look like they were developing, but now we've been bouncing. Are we going to be able to avoid that, or are we going to see some weakness? And then we went eventually into the October lows. So what are the warning signs? We're keeping an eye on these defensive sectors like staples, utilities, and healthcare. We're watching energy, specifically oil, for geopolitical reasons. Growth to value, it could be improving, but they're not really showing any leadership right now. The home builder study is diverging, which I'm not really sure if it's positive or negative. We'll have to see how that plays out. We do have quite a long list, though, on the positive side. The 5-day and 10-day equity put call ratio charts are going down. And then we take our smart money indicators together, they are positive. The advanced decline lines are still doing okay. Both the S&P and NYSE McClellan oscillators and summation indexes are positive. Swenlin trading oscillator, parabolic SAR, our oscillators are all pretty much switched over to positive now. And we look at the bullish percent index for the S&P, NASDAQ 100, and the NYSE, they are all positive. The ease of movement is positive. The money flow, the ultimate oscillator, the Copic curve, and the vortex continue to be positive. The financial sector is positive, and the momentum for the NASDAQ 100 is positive. So our conclusion, we're still positive, but right now, it just looks like we had a bit of a down day, no real conviction on either side. So that's working to get rid of some of these extreme overbought readings that we're seeing right now. In the short term, we're still overbought, though. We still have a pretty long list. We're also seeing kind of a longer list with the intermediate term. We are still positive in the long term, but the 200 period moving average is still looking a little extreme, but that could also suggest good momentum. Thank you. I hope you have a really good day, and I will talk to you in the next video.